Well, good day and welcome back to ACG's series on investment planning. Today we're talking about investment types, part 3 of 5. My name is Matthew Coyle. I'm the head certified financial planner here at ACG. And I'd like to thank you for coming in and looking at the material today. Let's get started. Well, as a reminder, this is our series on investment planning. We've talked about setting investment goals, understanding risk. Today, of course, we're talking about investment types, and we'll be discussing designing and managing investment portfolios, and of course, taxes, other principles, and next steps. So let's talk about investment types as we move forward for this presentation. Well, generally speaking, in the world today, investing today typically involves one of three asset classes for most investors. The first is cash and cash equivalents. The second is bonds or fixed income. And the third are stocks, otherwise known as equities. Each possess a different risk and return profile, with stocks, of course, being the highest risk and expected return potential, and cash being the lowest risk and expected return potential. We've identified that here in a very simple graph with potential return on one axis and risk on the other axis. The lower and to the left you are, the less potential return you can earn, but of course the less risk you can take. The further out on the risk profile you go, the higher expected long-term rate of return, but the more volatility or fluctuation in price, aka risk, you should expect to take. In the category known as cash and cash equivalents, or cash alternatives, here are some of the common choices you will see. First off are savings accounts. These are probably very familiar to you and your family. They are FDIC insured accounts offered through your local bank or credit union and carry some type of Federal Deposit Insurance Corporation, or FDIC, insurance up to a certain level, usually $250,000 per account. A money market fund, also called a money market mutual fund, is an open-ended mutual market fund that invests in short-term debt securities such as U.S. Treasury bills or commercial paper or other types of short-term instruments. They are regarded as being a very safe deposit and do provide a very limited rate of return. Money market funds are an important provider of liquidity to financial intermediaries. Translation: money market funds are considered sacred among investors and usually try to maintain a market price of $1 per share. Familiar to many of you will be the Certificate of Deposit, or the CD. A CD is a savings certificate with a fixed maturity date and a specified fixed interest rate and is usually issued by a bank or your local credit union. A CD restricts access to the funds until the maturity date of the investment. CDs are generally issued by commercial banks and are insured by the FDIC up to $250,000 per individual account. One that might be unfamiliar to you is the Guaranteed Investment Contract, or GIC. GICs are insurance contracts that guarantee the owner principal repayment and a fixed or floating interest rate for a predetermined period of time. GICs are typically issued by insurance companies and marketed to institutions that qualify for favorable tax status under federal law. These products provide institutions with guaranteed returns and are very common in employer-sponsored retirement plans and may be used as a cash equivalent option. Yields on these investments are typically higher than most cash equivalents and may have scheduled liquidation restrictions or 12-month holding requirements, etc. These are typically responded at the participant level and are purchased by institutions on behalf of participants. Also familiar to many of you will be government savings bonds. A U.S. government savings bond is a common type of government bond, short-term bond, which is a bond issued by the U.S. to raise funds from the public to fill its capital projects or to pay for other short-term obligations. When the government sells these bonds, it is in effect taking a loan from the public, which it promises to pay back at a predetermined date in the future. As compensation for providing it with capital, the government makes interest payments back to its bondholders, and these are non-marketable and can be purchased in $25 increments up to $10,000 per year and are essentially zero coupon bonds, which mean you do not receive a regular payment, but buy the bond at a discount and redeem it at a maturity. Also familiar will be U.S. Treasury bills. A Treasury bill is a short-term debt obligation backed by the Treasury of the United States government, with maturities of less than 1 year, sold in denominations of $1,000 up to a maximum purchase of $5 million. T-bills have various maturities and are issued at a discount from par value. When an investor purchases a T-bill, the U.S. government effectively writes the investor an IOU. They do not receive regular interest payments, but purchase the bill at a discount and will mature it at a higher value when it matures. So let's talk today a little bit more about bonds and how they work. When you purchase a bond, the borrower will receive payments from the lender at a specified date for a specified period of time. At that point, the bond is said to have matured. When it reaches that maturity date, the full amount of the loan, which is the face value of the bond, must be repaid to the borrower. A bond typically pays a stated interest rate called a coupon over a period of time called a term. The term dates back to the days when a bondholder had to clip coupons attached to the bond and mail it in to receive each interest payment. As times have changed, most bonds pay interest on a fixed schedule electronically these days, and usually quarterly or semi-annually, although some pay all interest at maturity along with the principal. There are also monthly paying bonds, although they are less common. There are two fundamental ways that you can profit from owning bonds. The most obvious is the interest payments that you receive. However, you can also make money if you sell a bond for more than you paid for it. As with any security, bond prices move up and down in response to investor demand. They also are sensitive to changes in interest rates. Bonds redeemed prior to maturity may be worth more or less than their original cost, which represents a profit or loss for the investor, and those that seek to achieve higher yields also involve a higher degree of risk. For retirees, one of the most important reasons that investors choose to invest in bonds is for a steady and predictable stream of income through their retirement years. It is important to note, however, that bonds are not completely risk-free. For example, a bond issuer could default on a payment or fail to repay the principal. Bonds are considered somewhat less risky than stocks, but it's also because they have a longer and more stable history than the stock market. Corporations and businesses that issue bonds must repay the interest to their bondholders prior to issuing dividends to shareholders or buying back stock in the open market. Therefore, corporate bonds are generally considered to be less risky than corporate equity. If a corporation declares bankruptcy or dissolves, bondholders are first in line to be compensated for these losses. Stockholders are always last. The bond market often behaves very differently from stocks for this reason. And because of this dynamic, the bond market trades very differently from the stock market based on the condition that bondholders will be paid first. Also, something to consider is that various bonds are exempt from state and/or federal taxes, which makes certain issues of bonds more or less attractive to certain types of investors. So let's now talk about stocks, aka equities. When you buy a company's stock, you are purchasing a share of ownership in that business. As an owner, you become one of the company's stockholders, aka shareholders, and your percentage of ownership in a company also represents your share of the risks taken and the profits generated by that organization. If the company performs well, your shares will also perform well. The flip side, of course, is that your share of any losses will be proportionate to your percentage of ownership. Generally speaking, when you purchase stock, you can make money in one of two ways. The company's board of directors can decide to distribute a portion of the company's profits to you, the shareholder, as a dividend, which provides you with a certain amount of income. Also, if the value of the stock rises, you may be able to sell your stock for more than you paid for it, which of course will generate a capital gain, which is most likely going to be taxable. If the value of the stock has declined, you lose money, although you can possibly write some off as a tax-deductible loss. While of course past performance is no guarantee of future results, historically stocks have performed to a greater return potential than bonds over the long term. That return, of course, comes at a cost. Potential for greater returns always involves a greater risk of volatility and the potential for losses. Unlike bonds, stocks do not have capital protection, meaning that you are at the bottom of the totem pole when it comes to being repaid in the event of a dissolving corporation. You can lose part or all of the money you invest in a stock with no possibility for recourse. Because of that volatility, stock investments may not be appropriate for money you count on in the short term or require for short-term purchases. If you have questions about whether or not certain stock investments may be right for you, a money manager or certified financial planner may be able to help you through this process of deciding what exposure you wish to have. Keep in mind there are many different types of stock, and not all are the same, and not all have the same earnings potential. Ranging from micro cap or very small companies to large cap or very large companies, there are a wide array of classes of stock to invest in. Certain stocks have no income potential and are purely oriented around growth. Other stocks are known as income stocks. These may be utilities or financial companies or telecommunications companies. They generally offer higher dividend yields, which make them attractive for retirees. Again, if you have questions about these different types of stocks, please reach out to us and we can help you to understand what better might fit your needs. So with those topics covered, let's talk about building portfolios. In modern portfolio theory, there is something called an efficient frontier. An efficient frontier is a set of optimal portfolios at different levels of risk that offer the highest expected return for a defined level of risk or the lowest for a given level of expected return. Portfolios that lie below the efficient frontier are what we call suboptimal portfolios, because they do not provide enough return for the level of risk taken. The efficient frontier demonstrates the relationship between risk and return, and portfolios that are nearest to the efficient frontier are optimal portfolios, because they have a higher level of risk for a defined rate of return. It is also worth mentioning that there are other categories of investments you may want to consider beyond what we've already discussed. We've discussed cash alternatives, debt or fixed income investments. We've discussed treasury securities and equity or stock-based investments. But there are also insurance-based investment products or hybrid products, real estate products, collectibles, alternative assets, commodities, etc. Some of these are very specific with their own set of risks. Please consult with a financial professional if you have questions, or consult with a certified financial planner who may be of some assistance modeling this and may be of some assistance helping you decide which you may invest in. Another area that we see a lot of growth in are alternative investments. These are things like hedge funds, private equity, real estate, natural resources, collectibles, gold and precious metals, commodities, etc., including cryptocurrency. These, of course, have their own unique set of risks and their own unique set of pros and cons. What were once confined to a very small niche part of the market have now become mainstream, particularly hedge funds and private equity. Some of the advantages or pros of these investments include diversification, less correlation to traditional asset classes, returns, increased returns, and flexibility. Some of the negatives or cons include a lack of liquidity or lockup periods, a lack of transparency, and a lack of regulatory oversight, particularly in cryptocurrencies and hedge funds investments. Again, please consult with a certified financial planner or money manager if you have questions about these various types of investments. They may or may not be right for your situation. Well, as usual, I'd like to thank you for stopping by to view the material. My name is Matthew Coyle. I am the head CFP here at Advanced Capital Group. My information is there on the screen. If you have questions on anything you've seen today and would like to reach out with a question, please feel free to contact me. Thanks again for stopping by.